All right, let's begin now. We're going to look at Unit 3 now. Well, but I mean, again, definition for financial intermediaries yet. Answer. Shaman, remind me. Oh, Shane, remind me. Did you go through this last class, right, Shane?
I don't think so, sir. I don't remember that. I'm not sure, sir. Wait, did you go to the last class, you send it?
No, I never recorded the last session.
No, I'm not sure.
Never mind. Financial. So the unit is the financial institutions. Now look at financial intermediation now. Now, financial intermediation is a productive activity in which an financial intermediation is a productive activity in which an institutional unit incurs liabilities on its own account for the purpose of acquiring financial assets. By engaging in financial transactions on the market. The role of financial intermediaries is to channel funds from lenders to borrowers by intermediating between them. It's not more. So let's look at now the advantages of financial intermediaries. Now, financial intermediaries are as crucial to the economy as the blood is to the body. Some of its significant benefits are discussed below. First one is low risks. The involvement of intermediaries reduces the risk of fraudulent default and even capital loss for the lender. Convenience. Exchange becomes suitable for the investor as well as the borrower, since both the parties do not need to invest time and money in searching for each other. Instead, they have to approach the intermediary for the purpose. Next is economies of scale. The costs involved in the lending and borrowing of funds, like analyzing credit position, operational expenses, and the cost of paper, decreases to a large extent the financial intermediaries. The costs involved in lending and borrowing of funds, like analyzing credit position, operational expenses, and cost of paperwork, decreases to a large extent. The financial intermediaries perform such activities to a massive scale. Next advantage of financial intermediaries are financial specialization. These organizations or companies specialize in fund management and investing activities, providing better returns to the investors and easy loans to the borrowers. Next advantage is greater liquidity. The financial intermediaries, like banks, allow investors or depositors to withdraw their amount at any time, at any point of time, as per their requirement. Again, financial intermediaries like banks allow investors to or depositors to withdraw their amount at any point of time as per their requirement. Safe investment. For the investor's point of view, financial intermediaries are considered to be more trustworthy and reliable than lending money directly to an individual to yield interest. So this is a summary of the advantages of financial intermediaries: risk spreading, convenience, economies of scale, financial specialists, greater liquidity, and safe investment. Look at the disadvantages now of financial intermediaries. Everything has two phases. One is positive and the other is negative. As you already know, that financial intermediaries operate for profits. They are not charitable institutions. The following are some of its disadvantages. First, the first disadvantage is that there are low returns on investment. The ultimate aim of the financial intermediaries is to earn a profit, and therefore they usually provide a low rate of interest to the investment made by the depositors. Another disadvantage is that they're opposing goals. The goals of the investors and the financial intermediaries may not complement each other, and therefore the objective of one may not be achieved. Next, you have fees and commissions. These intermediaries impose charges like expenses and commission on the financial assistance they provide to their customers. For example, when banks are lending money or lending out loans, they always have a manner of fees that they charge you. Next one, false opportunities. Sometimes the financial intermediaries come up with the investment opportunities which guarantee high potential returns with the hidden risks involved in it. Even some of these may not yield the promised returns and turn out to be a failure for the investor, just like cash flows. High interest on loans. This is another disadvantage. High interest on loans. These financial intermediaries charge a high rate of interest on the loan provided to the borrowers to earn a profit. Okey-dokey. All right, let's continue. When raising capital, direct transfers of funds from individuals to businesses are most common for small businesses or in economies where financial markets and institutions are not well developed. Businesses in developed economies usually find it more difficult, businesses in developed economies usually find it more efficient to enlist the services of one or more financial institutions to raise capital. Most financial institutions don't compete in a single line of business, but instead provide a wide variety of services and products, both domestically and globally. Next look at now is the types of financial institutions. You have commercial banks, merchant banks and finance houses, and building societies. You have also investment banks, credit unions, insurance companies, and others. We'll look at these in a little bit more detail. First, look at deposit-taking financial intermediaries. Some financial institutions take deposits from savers and then lend most of the deposited money to borrowers. Following is a brief description of such intermediaries. First, on the savings and loan associations. S&Ls originally accepted deposits from many small savers and then loaned this money to home buyers and consumers. Later, they were allowed to make riskier investments such as real estate development. Mutual savings banks are similar to saving and loan associations, but they operate primarily in the northeastern states. Today, most S&Ls and MSMBs have been acquired by banks. We look at so the first type of deposit taking financial intermediary is savings and loan associations. All right. Credit unions, next one. Credit unions are cooperative associations whose members have a common bond, such as being employees of the same firm or living in the same geographic area. Member savings are loaned only to other members, generally for auto purchases, home improvement loans, and home mortgages. Credit unions are often the cheapest source of funds available to individual borrowers. Next, look at commercial banks. Commercial banks raise funds from depositors and by issuing stock and bonds to investors. For example, someone might deposit money in a checking account. In turn, that person can write checks, use a debit card, and even receive interest on deposits. So commercial banks raise funds from depositors and by issuing stock and bonds to investors. For example, someone might deposit money in a checking account. In return, that person can write checks, use a debit card, and even receive interest on deposits. Those who buy the bank's stocks expect to receive dividends and interest payments. Unlike non-financial corporations, most commercial banks are highly leveraged in the sense that they owe much more to their depositors and creditors than they raise from stockholders. Again, unlike non-financial corporations, Most commercial banks are highly leveraged in the sense that they owe much more to their depositors and creditors than they raise from stockholders. For example, a typical bank has about $90 of debt for every $10 of stockholders' equity. If the bank's assets are worth $100, we can calculate this equity capital by subtracting the $90 of liabilities from the $100 of assets. Equity capital equal 100 minus 90 equal 10. But if the assets drop in, banks are critically important to a well-functioning economy, and their high leverage makes them risky. As a result, banks are more highly regulated than non-financial firms. Given the high risk, banks might have a hard time attracting and retaining deposits unless the deposits are insured. So the Federal Deposit Insurance Corporation, which is backed by the US government, insures up to $250,000 per depositor. As a result of the global economic crisis, this insured amount was increased from $100,000 in 2008 to reassure depositors. With such insurance, if depositors believe that a bank was in trouble, they would rush to withdraw funds. This is called a bank run, which is exactly what happened in the US during the Great Depression, causing many bank failures and leading to the creation of the FDIC in an effort to prevent future bank runs. Bank runs withdraw all the money from one bank and bring it to another. Not all countries have their own versions of the FDIC. So international bank runs are still possible. In fact, a bank run occurred in September 2008 at the UK Bank Northern Rock, leading to its nationalization by the government. Next, now we'll look at investment banks and brokerage activities. Now, investment banking houses help companies raise capital. Such organizations underwrite security offerings, which means they advise corporations regarding the design and pricing of new securities. So investment banking houses now also buy these securities from the issuing corporation and resell them to investors. So in an example of an investment banking house would be Barita Investments. If you know about that one. All right. So investment banking houses help companies raise capital. Such organizations underwrite security offerings, which means they advise corporations regarding the design and pricing of new securities. And then they buy them and then resell them to investors. Although the securities are sold twice, this process is really one primary market transaction, with the investment banker acting as a facilitator to help transfer capital from savers to business. An investment bank often is a division or subsidiary of a larger company. One minute. Yes, sir. So an investment bank often is a division or subsidiary of a larger company. For example, JP Morgan Chase & Co. is a very large financial services firm with over 2 trillion in managed assets. One of its holdings is JP Morgan, an investment banking house. All right. In addition to security offerings, investment banks also provide consulting and advisory services, such as merger and acquisition, analysis, and investment management for wealthy individuals. Most investment banks also provide brokerage services for institutions and individuals called retail customers. For example, Merrill Lynch was a large retail brokerage corporation that provides advice and executes trades for its individual clients. It was acquired in 2008 by the Bank of America. Similarly, JP Morgan helps execute trades for institutional customers, such as pension funds. At one time, most investment banks were partnerships with the income generated primarily by fees from their underwriting. M&A consulting, asset management, and brokering activities. So at one time, most investment banks were partnerships with some income generated by primarily by fees from their underwriting. M&A consulting, asset management, and brokering activities. When business was good, investment banks generated high fees and paid big bonuses to their partners. When times were tough, investment banks paid no bonuses and often fired employees. In the 1990s, however, most investment banks were reorganized into publicly traded corporations, or acquired and then operated as subsidiaries of public companies. For example, in 1994, Lehman Brothers sold some of its own shares of stock to the public via an IPO. IPO means, via an IPO, let me turn the folks. And an IPO means international public offering. All right? IPO is international public offering. So, for example, in 1994, Lehman Brothers and sold some of its own shares of stock to the public via an IPO, which is referred to as international public offering. Like most corporations, Lehman Brothers was financed by a combination of equity and debt. Basically, the new regulations allowed investment banks to use an unprecedented amount of debt to finance their activities. Lehman used roughly $30 of debt for every dollar of equity. In addition to their free generating activities, most investment banks also began trading securities for their own accounts. In other words, they took the borrowed money and invested it in financial securities, which is a smart thing to do. If you are earning 12% on your investments while paying 8% on your borrowings, then the more money you borrow, the more profit you make. But if you are leveraged 30 to 1 and the investments decline in value by even 3.33%, your business will fail This is exactly what happened to Bear Stearns, Lehman Brothers, and Merrill Lynch in the fall of 2008 when the Great Depression. Next type of bank is investment funds. At some financial institutions, savers have an ownership interest in a pool of funds rather than owning a deposit account. Examples include mutual funds, hedge funds, and private equity funds. An example of I remember now, as usual, as the end of 10 minutes, please re-log in, all right? End of re-log in just for a few more minutes after this, all right? So re-log in as soon as the 9 minutes are over. All right, so investment funds include, so examples of investment funds are mutual funds, hedge funds, and private equity funds. Mutual funds are corporations that accept money from savers and then use these funds to buy financial instruments. These organizations pool funds, which allows them to reduce risks by diversification so mutual funds are corporations that accept money from savers and then use these funds to buy financial instruments. These organizations pool funds, which allows them to reduce risks by diversification and achieve economies of scale in analyzing securities, managing portfolios, and buying or selling securities. Yeah. Different funds are designed to meet the objectives of different types of savers. Hence, there are bond funds for those who desire safety and stock funds for savers who are willing to accept risks in the hope of higher returns. There are literally thousands of different mutual funds with dozens of different goals and purposes. Some funds are actively managed with their managers trying to find undervalued securities, while other funds are passively managed and simply try to minimize expenses by matching the returns on a particular market index. Next, look at money market funds and another type of investment fund. Money market funds invest in the short-term, low-risk securities such as treasury bills and commercial paper. Many of these funds offer interest-bearing checking accounts with rates that are greater than those offered by banks. So many people, Many people invest in mutual funds as an alternative to depositing money in a bank. So we can have this now, people invest in money market funds rather than have the money stuck in the bank. When the money is in the bank, it's not grow, not all basically sometimes, most times. Note though that money market funds are not required to be insured by the FDIC and so are riskier than bank deposits. Most traditional mutual funds follow investors to redeem their share of the fund only at the close of business. A special type of mutual fund, the exchange traded fund, allows investors to sell their share at any time during normal trading hours. The ETFs usually have very low management expenses and are rapidly gaining in popularity. Next type of investment fund is hedge fund. Hedge funds raise money from investors and engage in a variety of investment activities. Unlike typically mutual funds, which can have thousands of investors, hedge funds are limited to institutional investors and a relatively small number of high net worth individuals. Because these investors are supposed to be sophisticated, hedge funds are much less regulated than mutual funds. The first hedge funds literally try to hedge their bets by forming portfolios of conventional securities and derivatives in such a way as to limit their potential losses without sacrificing too much of their potential gains. Recently, though, most hedge funds began to lever their positions by borrowing heavily. Next, look at private equity funds. The next type of investment fund. Private equity funds are similar to hedge funds in that they are limited to a relatively small number of large investors, but they differ in that they own stock in other companies. And often control those companies. Whereas hedge funds usually own many different types of securities. In contrast to a mutual fund, which might own a small percentage of a publicly traded company's stock, a private equity fund typically owns virtually all of a company's stock. Because the company's stock is not traded in public markets, it is called private equity. In fact, private equity funds often take a public company, a subsidiary, and turn it private, such as the 2007 privatization of Chrysler or Cerberus. Then we look at life insurance companies now and pension funds. Life insurance companies take premiums, invest these funds in stocks, bonds, real estate, and mortgages, and then make payments to beneficiaries. Life insurance companies also offer a variety of tax-deferred savings plans designed to provide retirement benefits. We have less than 1 minute left to go, so please re-log in so we can resume. All right. For a little while longer, so we can finish this unit and forget about it and move on. next class. So please log in, re-log in, please, gentle folks. Please re-log in.